If you're an options trader, you hear these phrases all the time. In the money, out of the money. This is what we call moneyness, and honestly, it's the language of options. If you want to get fluent, you've got to master this. So let's get right into it. Right, so you've definitely heard traders throwing these terms around. ITM, ATM, and OTM. Look, this isn't just a bunch of fancy jargon to make things sound complicated. It's actually a super useful classification system that tells you pretty much everything you need to know about an option status in a single glance. And by the time we're done here, you're going to be able to look at any option and know exactly what's what. The best part? The entire thing, this whole system, it all comes down to just one single core concept. You get that one thing, and I promise the rest just falls right into place. So here's how we're going to tackle this. First, we're going to nail down that one core concept, intrinsic value. Then we'll use it to classify calls, and then puts. After that, we'll see how it all looks in the real world on an option chain. And finally, we'll get to the big question. Why does any of this actually matter for your trading? Okay, first things first, let's talk about intrinsic value. This really is the key. You understand this, you understand moneyness. So what in the world is intrinsic value? Well, think of it like this. If you could press a button and exercise your option contract right this second, how much real, actual money would it be worth? That's its intrinsic value. And for this calculation, just for a moment, we're going to completely ignore the premium you paid for it. And figuring it out is super, super simple. For a call option, you just take the current stock price, the spot price, and subtract your strike price. For a put option, you just flip it around, you take the strike price and subtract the spot price. That's it. These two little formulas are the secret sauce to everything we're talking about. But hold on a minute. Let's look at that formula for calls again. Spot price minus strike price. What if the stock price is, lower than the strike you bought? The math would give you a negative number, right? So why can't the intrinsic value ever actually be negative? It all comes down to the number one rule of buying options. Your risk is limited. The absolute most you can ever lose is the premium you paid to get into the trade. Period. If intrinsic value could go negative, that would mean you could lose more than your premium, and that just breaks the whole system. So the rule is simple. If the formula gives you a negative number, the intrinsic value is just 0. Think of 0 as the floor. It can't go any lower. All right, part 2. Let's take what we've just learned about intrinsic value and apply it to call options. So here are the official labels. If an option has some positive, real intrinsic value, anything more than 0, we say it's in the money, or ITM. If its intrinsic value is 0, then it's out of the money, or OTM. And that one strike price that's sitting right there, closest to the current spot price, that one's special. We call it at the money, or ATM. It's kind of like the dividing line. Let's make this real with a quick example. Imagine the Nifty spot price is at 80.60. A call option with a 7,500 strike is worth what? 80.60 minus 7,500 is 560. That's a positive number. So that option is in the money. Now, what about a call with an 8,300 strike? Well, 80.60 minus 8,300 is a negative number, which means its intrinsic value is simply 0. That option is out of the money. See how that works? Okay, on to put options. And the great news is, you already know how to do this. It's the exact same logic we just used for calls. It's just flipped on its head. This is the one thing you really gotta lock in. For call options, the strikes below the current stock price are the ones that are in the money. But for put options, it's the total opposite. The strikes above the stock price are in the money. And that makes perfect sense, right? A put gives you the right to sell, so it's valuable when you can sell the stock for more than it's actually worth in the market. Let's run the numbers for a put. Say Nifty is trading at 82.02. An 8,500 strike put has an intrinsic value of 8,500 minus 82.02, which is 298. It's positive, so it's in the money. Now, let's look at a 7,500 strike put. The math is 7,500 minus 82.02. That's a negative number. So what's the intrinsic value? 0. And that means it's out of the money. Simple as that. Okay, theory is great, but where does the rubber meet the road? Where do we see all this stuff in the real world? The answer is the option chain. This is where it all comes to life. And this is what it looks like. Now, I know, it can seem like a wall of numbers at first, but the layout is actually really straightforward. You've got all the call options on the left side, all the put options on the right, and all the different strike prices stacked right down the middle. And see that highlighted one, 67.5? That's the exchange telling us, hey, this is the at-the-money strike right now. Now, look a little closer. See that pale yellow background color? That is your best friend. It's a fantastic visual shortcut that the exchange gives us. Any option you see with that shaded background is in the money. You don't even need to do the math in your head. For calls on the left, you can see it's the strikes below the ATM strike. For puts on the right, it's the strikes above. It's designed to make spotting the ITM options almost instantaneous. So, okay, we can define all this, we can read it on an option chain, but why? Why does it matter? What is the actual so what for you and your trading decisions? So let's wrap this all up. Moneyness is just a simple way to classify if an option has real built-in value, intrinsic value, or not. Because ITM options have this value, they're always going to be more expensive than OTM options. And this feeds directly into your strategy. Do you want to pay more for an ITM option that's already got a head start, or do you go for a cheaper OTM option that needs a bigger move to pay off? And, maybe most importantly, all of this is the absolute bedrock for understanding the bigger forces that make option prices tick. So now you have the framework. You can look at any option chain and instantly know if it's in the money, at the money, or out of the money. But that brings up a much bigger question. We know what intrinsic value is, but what about the rest of an option's price? What are those invisible forces that make some premiums explode while others just fade away to nothing? Well, that's where things get really interesting. Thanks for joining